Talk About It Tuesday question is: interest rates are high and the feds are considering raising them again. The real estate market is in decline, and analysts suggest that the stock market will be negatively affected too. How should we change our investment strategy? I love this question. If you've been paying attention to the news, you do realize that interest rates are higher than they've been in decades. And the real estate market has cooled off completely. So let's talk about why. So we saw record high prices for real estate during the COVID crisis. All of a sudden, everybody wanted to relocate, and interest rates were at a record low at that time. So borrowing was cheap and easy. And because of the huge demand and the low surplus, um, prices of real estate climbed and climbed and climbed outrageously. And we saw that the COVID crisis itself caused massive inflation. So the feds, in order to curb inflation, have to raise interest rates, or that's one of their tools for trying to curb inflation, is to raise interest rates to cool off buying. When you cool off buying, basically supply and demand, then prices eventually come down. So how does that affect real estate? Is now a good time to buy real estate? Well, we know inventory is low, right? However, the prices have not come down yet to match the amount of buyers that are falling out of the market. So right now, prices are high and interest rates are high. As the market continues to cool and the amount of buyers starts to diminish even more, you'll see an increase in inventory, which means competition among sellers, which means prices will come down. So it's an eventuality that the prices of real estate will start to come down, especially if there's another increase in the interest rates. So if you're an investor who has real estate in your portfolio, then you just have to be a little bit patient because prices will come down. The question is, how far down is good enough for you? Because you have to also look at, if you're an investor, not a home buyer, even if you're a home buyer, and you buy it at this inflated interest rate, but the price is low enough you can make your monthly payments, eventually the interest rates are going to come down and you can always refinance at a lower interest rate. So right now it's about being patient and finding that right number that makes sense for you to be able to cover the monthly payment, and even the right price, right? Because you don't want to buy it at a price and then it never appreciate or take a long time to appreciate back to where you bought it, the price you bought it at. So it's finding that right price at the right time, understanding that eventually you can refinance at a lower interest rate. So that's real estate. The stock market. The entire stock market is not going to be negatively affected. What we tend to see when interest rates are high, what goes down, we see tech stocks tend to go down, all of what you call the growth stocks, right? Because tech companies rely upon borrowing money constantly and they can't expand and do all the things that they do if they can't borrow money at a price, at an interest rate that makes sense. So you'll see them start to curb spending, stop borrowing, and the prices of stocks for growth companies, tech companies in particular, tends to drop significantly. So would it be a good time to buy that? Well, it's about the value. You have to look at, do you think that company is going to come back? Um, and so when the price is down, are you buying it at a sale price, right? Because the prices will come down. The question is, do you buy it now with the expectation that it will bounce back because the company is strong enough that it will continue to grow in the future? Same thing happens with, you're talking about everything in the financial industry. So brokerages and banks, their stock values plummet because they can't lend money because their interest rates are too high, so people aren't borrowing. That's how they make their money. So if you look at certain banks, strong banks, eventually they'll come back, right? And so again, do you buy them at a lower price? Yeah, you wait for those prices to drop. So it's below market value, below what you believe the market value should be, and then you can buy it, at that lower price. Um, But do you put all your money in the things that are going down? No. So take advantage of the high interest rates. So you can park a lot of your money right now in interest income. So CDs, money market accounts, anything that's bearing interest because the interest rates are so high. So right now you can get CDs and money market accounts at 4.5 to 5.5%, and there's no risk, right? Just parking your money, no risk, waiting for those other things to get to that right point for you to then pull it out and invest it at the lower price point. So should you be changing your investment strategy now? That should be your investment strategy all along, but how you redistribute your portfolio, right? How you rebalance your portfolio makes sense based on the interest rates and and the effect it has on each of those asset classes. So hopefully that was helpful. I'd like to hear your strategy and what you're doing and how you see interest rates affecting the market. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.